As always, yours truly, Mentor Jojo or Captain Jojo is here to lead the class. I represent Diamond FX, of which there are 3 mentors. The senior most trader is Commander Wise. Then we have Captain Nanakwisi Osei, who joined us for, I think, last 2 lectures. Then myself. So don't look at Diamond office as just me, Tichi. No, we are 3 mentors. I just represent them here on this course. Okay, let's start. So we're going to talk about liquidity concepts. Liquidity concept is a very, very important topic in Forex. So we'll dive into liquidity concepts. It's one of the most misunderstood yet powerful concepts in trading. And when we understand how liquidity works, it will help us to navigate the market, looking at areas where we should avoid becoming the liquidity. Because you don't want to become the liquidity. In order not to become the liquidity, you must know where the liquidity is. And it is said, and I quote, if you can't find where the liquidity is, then you are the liquidity. So my brothers, this evening, let's delve into liquidity concepts. Like always, we have 2 parts of the presentation. We'll do the theory, which is a slides PowerPoint presentation. Then we'll go to the charts and apply what we've learned here from the slides. So grab your pen and notebook, put down some notes, and note anything that either I was talking too fast or you need some clarity. So that once I bring this first session to a close, you can ask your questions before we go to the live chats. So what are our learning objectives? At the end of this session, each of you listening to me should be able to define what liquidity is in the context of forex trading. Identify where liquidity pools form on the chart, and recognize how manipulation tactics like stop hands and inducement are used to make you or turn you into a liquidity, and how you can use liquidity to improve your trading entry and exits. So in broad terms, not just forex, in broad terms, liquidity in economics, liquidity refers to how easily an asset can be bought or sold without affecting the price. So high liquidity means that there are many buyers and sellers for that particular commodity or asset class. So when trades are placed, they execute smoothly. There are no issues with it. Low liquidity, however, means that there are fewer participants, there are fewer sellers, and there are fewer buyers. So at times, certain sales place or certain buyers place do not even execute. So they can do what we call, they can slip. Okay. But in forex trading, to be specific, liquidity is a dynamic terminology, but it's often concentrated around key price levels. So institutions, one thing you must know about institutions is that institutions, when they want to enter a trade, they need to post liquidity. So let me explain. If they're big institutions, the hedge funds, as we call them, the smart money, if they want to enter a buy, what they need to post in liquidity, they must move price like as if it is selling. So where you have placed your stop loss based on your POI, point of interest you've identified on the chart, they will push price below your POI or your point of interest or your zones that you want to trade from. So they want to buy. You too, you want to buy. But they have large orders and they need liquidity to move. They need to take your stop losses. That's what we call the stop hands. They need to take your stop losses. They need to take those who are trying to do sell stops. So they will move price. That's what they call the manipulation tactics. They will move price below your key zone to clear all your money. Sorry, I think Inshura just went off. It's now asking to be admitted. Okay, that's fine. So they will deliberately move price, or they will manipulate price. Price will go below your key zone to where your stop loss is and clear you out of the trade before they go up. That is why when you are placing your trades, you want to be mindful of liquidity. So as I said, institutions need opposing liquidity to enter a trade. So if institutions want to sell, they will move price up because you who are selling, you have placed your stop loss above price. But if you don't place your stop loss in the proper place and it's in liquidity, they will move price up and take out your stop loss. And there's some people too, they've set buy stops. They want price to take them, and so they will trigger all those buy stops and now sell. So keep that in mind. But one thing you must always know, that I've always said, this is a summary. Liquidity zones always attract smart money. Always, always. Once you understand this, you must know that behind trend lines, behind all other key zones, they are liquidity. So you must place your stop losses outside liquidity zones. Okay. So what are liquidity pools? So these are clusters of stop loss and orders you place there. Like I just said, if you want to buy, you place your stop loss below your key zone. Somebody who wants to do a breakout trader, he will put a sell stop. He thinks that once price go below where your stop loss is, it means price is ready to sell. It might not be true. So they will take, the smart money will take all of them out before they go up. And liquidity pools are just clusters of stop losses and orders at key levels. It can be below structural highs or above structural lows. And these act as magnets. They always draw price to them. So price always seems to go for liquidity before it reverses. I'll demonstrate it to you when we go on the live chat very soon. So inducement. If you check the definition of inducement from the dictionary, you can just check that whilst I'm even talking. So inducement basically is someone enticing you to take an action or to do something. Okay. So inducement in trading basically means that smart money will trick retail traders like me and you to enter the trade earlier than before. Then later they will come and clear us as liquidity. So price might form a clean trend line or a support level, which will tell you that, oh, I have a support level, I can enter buy from here. Only for price to later break below the support level and sweep all your stops, your stop losses. So this also creates liquidity for the big institutions, for them to enter in the opposite direction. So when you organize inducement, you avoid traps and trade smartly with a smart man. So stop hands, I've talked about stop hands already. I'll just gloss over briefly. So stop hands are deliberate moves to trigger stop losses. They often occur before major news events at session opens like New York or London, near obvious highs and lows. And after the sweep of liquidity, price often reverses sharply. Don't panic. You have to learn how to expect these moves and use them to your advantage. So what are the types of liquidity? This one, I won't talk too much about it. I'll explain it better on the slides. But I'll just say it because you are looking at the slide. There's something called buy-side liquidity. So when you talk about buy-side liquidity, it means there are liquidity pools above highs of price. And once those liquidity are taken, price will reverse in the opposite direction. It means once buy-side liquidity is taken, price will go lower. Sell-side liquidity is the opposite. Sell-side liquidity is below support or swing lows or below key levels. Then we have internal liquidity, which I will try and explain all that. Note that I will explain that on the chart. Some of these things are difficult to explain when I'm just reading, but when you are seeing the chart and I'm going through them, it makes more sense. Okay. Then we talk about trend line liquidity, liquidity behind support and resistance, liquidity behind supply and demand, liquidity behind other blocks and what have you. So when you are trading with liquidity, you must be mindful of the fact that any zone you have identified to trade from, you must look for liquidity around that zone. And make sure you don't place your stop loss in the liquidity zone. Otherwise, you become the liquidity. And if you want to trade with liquidity, you must always wait for sweep of liquidity and what we call confirmation on a lower time frame. So confirmation can be a candlestick pattern, like a bullish engulfing or a bearish engulfing, or a morning star or evening star. But you must have a clear break of structure on a lower time frame after liquidity has been swept before you look for your confirmation. So let me say it again. Let's assume that you want to buy and you mark your key zones. Price has now swept liquidity below your key zone. It doesn't mean you should enter. You should wait for price to create structure, market structure. Let there be a clear demonstration of market structure. That shows that you understand what or you know what you are doing. So you realize that price will go up, come down, go up again, break the structure. Then you wait for price to return again to the area where it started the break of structure from. Our demonstration is on the chart. Then you mark the area and wait for a candlestick pattern to enter the trade. And when you are trading with liquidity, liquidity can be used as an entry, as I've just explained from the previous slide, or it can be your TP or target. And when you combine liquidity with supply and demand and market structure, you have a winning edge that will make you become more profitable on the market. So in summary, liquidity drives institutional behavior. Price seeks liquidity before major moves. So anytime you want to enter a trade, you look at the chart. There have not been liquidity sweep. You are better off no entry. Wait. It doesn't matter if some people have entered and they are showing their profit. Wait. Wait for price to take liquidity before you enter. Stop hands and inducement are tools of manipulation for smart money. You must use liquidity zones for what? Precise entries and exits. So this is your assignment. Take note of your assignment. You are to mark 3 liquidity pools on live charts. Then you annotate with expected sweep and entry logic, and you submit screens for review or marking by your mentor. So when you submit your screen, like always, I'll pass a comment if there's a need to say something about them on the charts. So thank you very much. End of lecture, part 1. Now we are going to go to the part 2 of the lecture. So let me pause whether there are any questions before we go to the part 2 of the lecture. Any questions so far, guys?
I think when you are done with the practical, then you to ask questions because I think it's plenty.
It's plenty. Yeah.
It's doing me plenty for my phone.
Usually when you talk about it like this, it's like some way bit to some of us until you start demonstrating on the charts. You know, they see nothing.
Yo, Mate. Mate, I've heard you. Let me remove all these indicators that I was using to. Actually, I have a student, a friend who has been disturbing me to teach him how to trade. And I was explaining something to him when he came around today. Okay. So we are talking about liquidity. So should we use gold or should we use Euro USD or should we use, you can use any pair, it doesn't matter. Okay, let's use gold. Let's use gold. As always, I always go to higher time frame. You know me and my style. Forget about the things I've marked there. I've marked things to help me analyze the chart the way I want to look at the charts. So you forget about the things I've written here. So daily, market is overall bullish, but for some time now, it has been going down. So as you can see, after the formation of the double top, price has been going down. Then now it has started going up again. Okay. Okay, so let me go to 4 hour. So we talk about liquidity. So let me start by writing here areas where you can find liquidity. Using LQ for short for liquidity. So areas you can find liquidity. So you have structural one. You have structural lows and highs. I'll explain that shortly. So structural lows and highs. So when it comes to the low is below the low. When it comes to the high is above the high. So there's liquidity above structural highs and below structural lows. Then you talk about trend line. Trend line, there's liquidity behind trend lines. Then talk about E zones. Or if you like what we call point of interest. So point of interest here can mean support and resistance, demand and supply, other blocks, fib levels, or what have you. So these are the areas you can find liquidity. So let's use this as a guide. So let's go to the charts. You only talk about what you see, not what is intended to be seen or implied to be seen. So it's a shame I have to clear all these things. Let me look for a new chart. I don't want to clean this because this is my chart I used to trade. Okay, you let me use it to your screen. So you realize that price came here. Make sure there's no indicator on. Okay, there's indicator on. Okay, good. So price came here. From the top, it came down, went up, came down, went up, then went down. If you watch here very well, where I am talking about this area, where I'm highlighting now, this area, I can tell you an authority that above all these wicks, all these areas are all liquidity pools. It is a liquidity pool because we defined areas you can find liquidity as what? Structural lows and highs. So market went up, came down, went up, came down. These are structural highs. And behind them are liquidity. Behind them are liquidity. That's what I've highlighted here. Behind all these areas are liquidity pools. So anytime price is approaching there, you are mindful. And exactly that's what gold did. You see, I've marked lines. I've put lines there to mark each of the liquidity pool, the structure. I've marked them. That's why I put that faint line on top. On each of them, I've marked this one. I've marked this one. I've marked this one. So I'm trading with the knowledge I have. I'm not guessing. I'm not gambling. So I know there's a liquidity pool there. So the moment this price here, gold, the moment gold came back, it didn't break, it didn't go through. It left a wick, left a wick, left a wick. I knew gold was going to sell. And it sold. And gold sold. So if I look at this chart, this is higher time frame chart. So if I go to 1 hour, you still see the liquidity pools there. These are all liquidity pools. And I'm using the concept of what? The structural high and low. That's all I'm using. Structural highs and lows. But I'm not doing trend line yet. You can't talk about trend line liquidity when I'm not doing a trend line. So this is liquidity that price took. So price took the first liquidity. This second liquidity and the third liquidity are all there. That's not been taken. But price just took this one and came down. And where did price stop? For those of you who have been following the lectures, Why did price stop? What led to the price stopping? What have I marked here? What area is it? What zone is this?
A place of demand.
What's a
demand zone.
Yeah, it's a demand zone. So I've not taught you guys demand zone, but we've done other block. Okay, we've not done demand zone, but we've done other block. So we've done other block, but we've not done demand zone. The next lecture will be demand and supply. So price stop here when it was coming down. You see, overall, gold is bullish. So on a much higher time frame, you can say this dumping, which is significant. This dumping here, which is a little over 1,000 pips. Somebody will say just a pullback. But on a lower time frame, it's significant. 1,000 pips on gold is significant. It is. So gold dumped, and you see, market respects structure and zones. Gold dumped to what? A demand zone. And started going up again. That is not the focus of today's lecture. Today we are doing liquidity. Okay, we are doing liquidity. I can tell you on authority that this is also a liquidity. It's actually an inducement. So you see, equal lows. First of all, we said be above structural highs and structural lows. So you see that clearly this and this is equal lows. And below equal lows are what? Liquidity, because it's still a structural low. So make it simple for yourself. See them as structural lows. So there are liquidities below structural lows. There's another structural low here. Here. This is also a structural low. Okay. So if you mark this your demand, you mark this your demand. Is this demand lead to a break of structure? Yes, it did. That is a break of structure. As I said, we've not done demand, so supply, so I won't bother you. But I'll just say it later when we do it, it makes more sense. So this is a valid demand zone. And these are all areas of liquidity. And if you watch clearly, price took this liquidity, but there was no clear zone here for price to trade from. So price kept moving till it got to a zone. And most of the time, when there's a clear liquidity here and price has taken it, it doesn't come down to take any other liquidity again because it's the demand. It's when there's no obvious inducement or no obvious liquidity in front of the demand zone that price tend to come below it. Because once there's no liquidity in front of the demand zone or the key zone, then the liquidity will be where? It will be below or behind the zone or above when you're talking about supply zone or bearish order block. So this is for structural high and low. Now let me see whether I can identify a trend line liquidity, or even demand and supply liquidity. Let me see if I can identify some for you. Okay. So this one is an example of a trend line liquidity. So I said that I've said this many times, but maybe we've not done this as a topic in isolation. I've said that to draw a trend line for a downtrend, you connect at least two higher, for an uptrend. For an uptrend, you connect at least two higher lows. So this is a low, this is a low. You connect them and extend. That's a trend line. So for me to redo it for you to see, I'll go to my tool here, take my trend line, pick this point, pick the next point here, and extend it. So I'm picking just 2 points. And once price touches 2 points, is a valid trend line. A third touch gives it strength, or as we say, validity. So if you watch, after, let me, okay. So in real time, after price, so you've drawn this is your trend line. This is how it looks like. So you've drawn your trend line, okay? Price has touched it. You expect price to go up or do whatever I want to do. Then price comes down. And went below the trend line before going up, meaning that smart money wants to go up. But smart money knows that you put your trade here and you'll be stingy with your stop loss. You probably make your stop loss so tight. Let me go to even a smaller time for like 15 minutes. Let me make this smaller. Okay, and enlarge this. Smart money knows that retail traders are stingy. They don't want to lose even a dollar. So they will place their stop loss so tight like that. Then smart money will go below, it will wick below the trend line. Take your stop loss before continuing. Then you'll be like, look at this. My village people are following me. I'm not lucky. Trading is not for me. No, trading is for you. You have to lose this trade and learn lesson that your stop loss must not be so stingy. Okay? Your stop loss must not be so stingy.
Yeah.
So this is an example of a trend line liquidity. So we've done structural high and low, we've done trend line. I don't know if there are any questions for me so far before I continue.
Is it?
Any question for me before we continue, guys?
Okay.
Hello? Or any question for me before we continue, guys? Guys, you are too quiet for me. What's happening? You are too quiet for me. What's happening? Are you following what I'm saying? Or you are lost?
For me, I'm lost.
Who is lost? I can't hear you. Your voice are faint, or it was me. Who is lost?
I'm a lost man here.
Why are you lost?
I'm following, I think.
I gave areas where to find liquidity. We've done structural lows and high. We've gone through that one. We just did trend lines right now. I said I've not done trend line as a topic on its own, but at least I've given you a crash course right now. If you want to draw a trend line, you just mark 2 key points on the market. So you take your trend line to. Hey, what are you saying? Who is talking? Reggie. Guys, I want to understand what you are saying. If you don't understand, let me know, because I'm here because of you. And I said, today I have a meeting at 6:15. I don't want us to make this lecture too long. So what don't you understand? So that I'll go over it quickly. Guys, I beg you. We've done the structural, we've done this one, we've done this one, we've done structural lows and high. That one too, you don't understand, or you understand?
No.
Okay, if you don't understand, let me draw it for you. So for an uptrend, where is the liquidity? For an uptrend, there's liquidity here. For an uptrend, there's liquidity here. There's liquidity here. There's liquidity here. There's also liquidity here. There's liquidity here. there's liquidity here. So for price to continue going up, it must take the liquidity here. Okay, after taking the liquidity, it comes back, then takes liquidity here again, goes up and comes down again. So anytime price takes liquidity, it goes the opposite direction. So it takes the liquidity from here, it comes down. Takes the liquidity from here, it comes down. The same way when you do a downtrend. This is basic liquidity concept too. There's a whole course on advanced liquidity, which is a different course on its own. That's a different course on its own. The whole course itself is advanced liquidity. That's a course. That course is 1 month. That one is $500. That one is for people who are advanced traders, not beginner traders. So here, you come down, and I teach that class as well. Come down, you go up. That's my downtrend. Okay, your lower high, lower lows. Okay, so here, price comes here. So here you have your liquidity the same way you have your liquidity here. Okay, and you have your liquidity here, 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 just the way we did for the uptrend. So once you have liquidity here. Oh, this thing, anytime I do it, it doesn't work well. Okay, that's fine. So you have liquidity here, you have liquidity here, you have liquidity. So price comes down, take the liquidity and comes back. The reason why when you're doing advanced market structure, they will tell you that every time there's a break of structure, price pulls back. Price pulls back because it has taken liquidity. And after taking liquidity, it must reverse for a while. So price comes down, goes up, comes all the way down, takes the liquidity from here. As soon as it's taking the liquidity, it goes back a little, that's pulled back. Then it comes down again, takes the liquidity here, and continue. So these are examples of structural highs and lows. Okay. These are examples of structural lows and highs. Cancel. So any questions on the structural highs and low? I also demonstrated with this here. I did this demonstration, guys. As I said, I'm at a different level. So if you don't understand, let me know. So I marked this here. Because if you watch them, they were almost at the same level. Okay. They were almost all at the same level. So price wick down. You see that as soon as price wick down, it pulls back a bit before it continued. And here too, as soon as price took the liquidity, it pulls back and is going the opposite direction. So you must understand it like that. Once price takes liquidity, there will be a pullback. It can be a permanent change of direction or a pullback. So let me put it this way. Once price takes liquidity, it goes in the opposite direction. But depending on the objective of price, it can be a pullback or a major reversal. Okay? Depending on the objective of price, it can be a pullback or a major reversal. So that is for structural highs and low. And we've already talked about liquidity pools. You see, the moment price came down here and came here and went down, right? And there's liquidity here. What is now a structural high? Do you understand?
Mm-hmm.
This is now a structural high because it's higher than this. So there's now liquidity here. And this liquidity here is in line with the already existing liquidity pool here that I've marked with my red lines. So it will take a lot for price to go through this pool. So if gold is going up and gold is approaching this zone, if I'm you, I'll take about 90% of my profit once gold reaches this zone. Once gold reaches this zone, I will take 90% or 95% of my profit because it can potentially reverse again and come down again after probably taking this one. You know, we have two more liquidity pools that have not been tapped into. Gold took only this one. Gold can take this one and reverse.
So
you can do that. Or I'm coming. Or gold can take all of them can take all the two and reverse before later breaking it and going up. We don't know what gold will do. Your job is not to predict what price will do. Your job is to react to what price is doing. Okay, now ask your question, George.
Taking 90% of your profit means you raise your stop loss.
No. Maybe I'll have to teach you that guy like that. When we do the live trading is Wednesday and tomorrow. Remind me to teach you how to take part of your profit off.
Okay.
It's not about raising stop loss. No, it's not. You remind me when we do the live trading tomorrow. And I realized that the time daylight saving times have changed. So the lecture time we're doing the live, I think we have to adjust it because we said 11:30. That was based on assumption that the crossing over will be. Let me even show you that one. Let me show you what I'm talking about. Okay, so you watch here. This is baby pips in GMT plus 0, like Ghana time. In the past, the overlap between New York and London was 12, but now it's 1. So I think instead of doing the lecture at 11:30, you should not do the lecture at 12:30. So that we have 30 minutes to look at the chart before the overlap begins. I don't know if it's a good plan for you guys. Is it a good plan? Guys, you are okay. Guys, you see, because we are changing the time, I need all your opinion because we are changing the time from 11:30 to 12:30. So I need your opinion. It's not an imposition. I'm not imposing it on you. So let me hear from you guys.
Well, the line has been on and off, but what is the actual benefit? It means that we are starting live trading before the before the New York session starts.
No, we are starting it at the overlap. So some few minutes to the overlap. And the reason why we are doing that is that it's during the overlap that there's high volatility. Meaning that if we are lucky and we get a good trade, within 1 hour or 2, we'll be out of the trade. We don't need to sit behind the chart forever.
That's fine. That's fine with me.
Because there are times you can enter a trade and you can sit behind the chart for hours upon hours. It's boring for me. I don't find those things interesting. So the best time I take my trades are during overlap. Because today I realized the overlap has changed. It's today I realized. Because my assumption was 12, but it has pushed ahead 1 hour ahead. So if it's 1 hour ahead, then 11:30 means that we'll spend too long a time sitting behind the chart. And that's how come last week, price was not going anywhere. And we're sitting behind the chart, price was not going anywhere. We couldn't trade, if you remember.
Exactly.
Yes.
I remember perfectly.
That is why I'm saying we should change the time. Because the essence of the live trade is to find setups during the live chat. Then we'll all enter the trade and see how it goes. That's the essence of the live trade. It's not just let me teach you how to enter trade. No. We are going to pick setup and you see how I think using the concepts I'm teaching you. So that when you are on your own after 1 month, I'm not saying you know everything about trading, but on your own after 1 month, you can do certain basic things. Like you can look at the chart, you can mark your bullish order block, bearish order block, you can mark your trend lines, you can identify liquidity, you can identify market structure and say, market, this one is an uptrend, this is a downtrend, this is a choppy consolidation market. So once you identify these basic things, you can make sense of the chart. You can identify certain candlestick patterns. Then you can say, okay, based on this, I am entering the trade. And when I enter the trade, when we do risk management, you understand why you have to have a risk to reward ratio. You risk 1 to get 2, or risk 1 to get 3, or risk 1 to get 5. And your risk to reward ratio must be realistic. Because at times someone want to get 1 to 10 risk to reward ratio, which can happen in a week. But you want to get it today, it will not happen. And when you don't, when expectations are not met, then you become frustrated and all that.
Yeah.
So now, guys, the list I could do on the charts I have done. I don't know if you guys want me to do something again on the charts. So we've not done key zones. Let me see what I can find key zones on. Anyway, trend line is a key zone anyway.
Okay.
So a key zone basically means an area of interest or point of interest or zone of interest where you want to take a decision to trade.
Key zone.
That's basically what a key zone is. So a key zone can be a trend line. So on a trend line, the trend line I do away from. So we call something trend line bounce. I think I have to do trend line as a topic. You know, okay, it's not part of the content, but I'll do trend line as a topic. I'll do it. So the reason why you mark trend line is that you believe that price is going up. Example for an uptrend. So price has touched here, lower, went up, touch here, gone up. You believe that when it touch this again to go up. So once price touch the line and goes up, it's called trend line bounce. But when it goes through it and changes direction, we say that's broken the trend line. So we have a break of trend line or a trend line bounce. Now you're bouncing the ball against a wall. So the ball hits the trend line, it goes up. Hit the wall, it goes. So this trend line we have drawn here, you can extend it to infinity. Anytime price comes down, you expect that when price touches it, it will go up to show that the price is still going up. Once price changes direction, it will break the trend line. As I said, that is not the focus of this lecture. This lecture is on liquidity. I can tell you right now that even right now at this low where it's bouncing from, if I see gold trying to come down right now, I know it's coming to take this liquidity here. This one. There's liquidity here. But these are structural lows. The moment you have a structural low here formed, now the liquidity is here. I know a guy who trades liquidity, but his strategy is crazy. The way I will enter a buy here, he will not. Well, if I enter a buy here, he will not. He will say there's liquidity here. So he will not enter a buy here until this liquidity is taken, then he will enter a buy. So if I told him I've entered this buy, he will tell me I should exit this trade at this supply zone. I know I'm not taught to supply. If he was on the chart, he would tell me, Techi, exit the trade here. Because price will come back down to take this liquidity. He will tell you price will come down and take this liquidity and come and clear this liquidity before going up. That's what he will say. He will say price will come and take this liquidity before going up. He has a very crazy concept of liquidity, but it works for him. And I understand how he thinks. I do. Because I read some book he gave me and I realized that I saw why he thinks like that. So he can take like 4 trades in a month. And he's profitable, he makes a lot of money. He has a huge capital. His lot sizes are 50 and 100.
Whoa.
Yeah. So he
He's
can
a
afford
big
to take
man.
4 trades. He can afford to take 4 trades in a month. So that's liquidity for you. We've not done supply and demand. Engineer Inshra already has advanced concept because he's been trading for a while. He's a very busy man. He has a lot of knowledge. Guys, worry him. We'll be contacting him at the backside and getting a pop. Engineer Inshra knows a lot. He's done some other courses before coming here. So worry him. So guys, basically liquidity, I can't say I will exhaust everything on liquidity here. But anytime we are even doing any other concept, I'll keep talking about liquidity. I'll keep talking about liquidity. I'll keep talking about liquidity. So that will be the constant thing that will feature in subsequent lectures till we are done with the course. Because you have to understand liquidity, guys. You have to understand liquidity. So I'll pause for any more questions. I know you don't like this topic because it's not sexy. The topic is not sexy, I know.
Doc.
Yep.
Yeah, Doc. I know you've spoken a lot, and like you said, you always talk about liquidity. But can you give me a brief? Yeah, I lost touch along the line, but can you just give me a brief, fast one? on liquidity.
What brief do you want? You tell me the brief you want.
How to identify a liquidity
Okay.
Yeah. How to identify liquidity.
Okay. Engineer Israel, do you have access to your computer?
Yes, please.
Engineer, share your charts and show your
Unless,
brother Philip how to find liquidity. Just share your charts.
unless I'm coming. Can you see my?
Don't want us to see the profit he's making.
Oh, I'm not trading. I haven't traded for a while. Can
you
you
have
see
the
my?
right to share your charts. Not yet.
Yeah. Unless, okay, I'm coming. Unless I set. They told me to restart the application.
Okay, whilst you are doing that, last prefect, share your charts.
Let me go offline.
Sure.
Let me restart the
Last prefect, share
application.
your charts. Yo, Martin Shira Cobra. Last prefect, share your charts.
Why is trading view?
I'm doing this because you guys were here with me. And Philip was driving and his network was cutting. So it's an opportunity to demonstrate how you understood it.
Can you see my chart?
Yes, I can.
Yes.
Okay. So this is trading view. From my understanding, to be honest, forget about all these markings on it's. I don't even know what they mean. I'm still trying to understand trading view and how it works. Okay, so let me go to a lesser. Let me see, 30 minutes or something. Okay, so from my understanding, let's take from this side coming down. It's on a downward trend, and then it started going up. Yes. So
bearish movement.
Yeah, it's on a bearish movement. Let me see if I'm able to do this. Oh no, that's not what I wanted. I'm coming. Get off. Okay. Okay. So Doc, how do you open the chart? How do you open the chart? So as it's going, you can see that it's forming that zigzag typical movement. So there is liquidity at every point high and every point low. So if you can see my cursor, this part is a high, as this part is a low. There is a lower low and then a lower high. Every lower low has liquidity. So for price to be able to move, it will get to the lower low, sweep the liquidity, go up to the lower high. At that point, it will sweep the liquidity there, go back to form another lower low, and then get the liquidity there and then move up. I hope Doc, I hope I'm making sense.
Yes, you are making a lot of sense.
Okay. So that's what my understanding of liquidity is. So from what I took from this lecture, if you identify this trend and then you are trading, understand that the big money, the hedge funds, the banks, and those people, when they come in, they thrive on liquidity to make the money by way of coming to take all your money on the market to go and do their business. You understand? So when you are putting a trade, once you identify the trend, don't be too stingy with your stop loss and then go and drop your stop loss in.
Hello.
Hello. Hello.
Okay.
Can you hear me?
Yes, I can hear you.
Okay. Don't be too stingy with your stop loss. Identify where the liquidity is and not drop your stop loss just in it or just below it. Because if you do that, you stand a higher chance of big money sweeping your money and then making the trend the way they want it, with you losing out. That's my understanding of today's what happened. I hope it was a good understanding.
Yeah. So that was structural high and lows. Okay. Thank you very much, George. You can stop sharing your screen. Philip.
Yeah, Doc.
Did it help?
Yes, it did. It did a bit, but I'll catch up.
Okay, don't worry. Engineer Shra, share your charts. Also tell us how you understood the lecture.
Okay. I'm coming. A minute. Okay.
Some of the things will make sense when you rewatch the video.
Can you see my chart?
Yes, engineer.
I mean, so when you talk about liquidity lies at the string high.
Your images are too tiny. But my enlarging the
Okay.
Yes.
So liquidity lies at the string high. So this place, such as here, there's liquidity here. Where there's wicks, especially long wicks, there's liquidity here. Here too, there's liquidity. This is a string low. This is a string. This one is the highest. The higher high for the day. Oh no, this one is 4 hour. Okay, this is the highest. So liquidity is here. Here to let's look at this area. Here to there's liquidity there, because there was a movement here. So here there's a liquidity here. So you can find liquidity mostly when you want to get the accurate liquidity zones. You use the higher time frame to identify the liquidity zones. So as Doc says, string highs and string low. So this one is the 4 hour window.
Okay.
You see, so here's the string high, here's the string low. So you can trade within this, but before you do that, you have to go to the smaller time frame. So as you go to a smaller time frame, you can identify, like, let's say, take the 1 hour. We take the 1 hour. If you take the 1 hour, you can see here there's an equal high. The whole place, the 1 hour, there's an equal high. That means liquidity was resting here. So the wicks took out the orders, the stop losses here. Then it brought it down. So here, did I use supply or the supply zone? So it grabbed the liquidity and came down here and get another liquidity here. That's the string low for the 4 hour. So fixed utility liquidity and went up. So that's why Doc was saying that there was another supply. Doc was using, I think, the 4 hour. Doc was saying there's another liquidity zone here. My chart is a little.
So can I say that wherever I see in a trend a string low one or two string lows, one or two string highs, it means that there has to be, or there will be some liquidity around it.
There's liquidity, but they are major
Minimal.
liquidity points. Okay, there are
Points,
some
yeah,
places
points.
where there's like this where I've marked this place. You
Mhm.
see, it's a strong liquidity zone.
Yeah.
Anytime price reach there, you see there's a price movement,
Mhm.
large volumes moving. So there are
Yeah.
places like here, this place, where from here to here, you see the movement is not all that strong.
Strong, yeah.
Yeah.
The market
So
wasn't, yeah. Okay.
yes, so from here to here can turn to be a consolidation.
Mhm.
Look, am I on the right track?
Yes, everything is correct.
If not, I'll be teaching some. So the place like from here to here, here to here, there will be just the market to be bouncing. So this one is consolidating. It will be consolidating around this area.
Okay.
That's why we have equal highs
Okay.
here and equal lows. So this place, especially at this area, that's where when you put your stop losses, the smart money will come and take your stop loss, then it will move up.
Okay.
So liquidity will be resting around this area
Sure.
because gold is now consolidating within that range.
Yeah.
Okay,
Okay.
so calm down.
Okay.
That's it. Philip,
All right.
is it
Thank
clear
you.
or is it still not clear?
You doc, don't worry. It's clear, but I'll need to personally sit down and then cut it into my piece, my own style pieces, and then
Okay.
and then sink it in. But it's clear.
I
At
think
least
what didn't
I
help
have
you
some
was
idea
that
about it.
during the lecture you were driving, so you missed some few things. So that's what.
Yeah. Yeah. But no problem. I'll catch up. I'll catch up.
But guys, forgive me. I know I rushed this lecture a little bit. Liquidity can be a bit confusing, but among all the lectures I've given today, I feel like I've rushed a little bit compared to the other days. Now, Reggie, boy,
I am pa.
I can't think back compared to even last week.
Yeah, probably.
So, gentlemen, is
Yes,
everything
sir.
sinking in now, or we still need to go over something again?
It's okay, though.
The floor is open. You can talk, guys. Feel free.
So it's okay for now. It's okay for now.
Okay, so let me just summarize by saying that liquidity is very, very important. Often it's misunderstood, but if you take time to understand it well, it will help you in your trading. No matter the strategy of your trading, whether you trade chart patterns or you trade ICT or you trade whatever, gorilla tactics, whatever formula you use to trade, if you understand liquidity, bro, you'll be a better trader. You'll be a better trader. Trust me. Liquidity is so important. I can show you so many things on the chart where my entry was purely because of liquidity. If I didn't have liquidity at the back of my head, I'm sure I would have not entered certain trades the way I entered them. So liquidity is so key, guys. It's so key. So just remember, when you draw a trend line, so for example, if you identify that a trend is going downtrend, when you are on a downtrend and you are drawing a trend line, you join the lower highs. So that's how you join to draw a trend line for a downtrend. You join the lower highs. You don't join the lower lows. So you just pick 2 points, the closest 2 points together, join them and extend it in the direction. That is a downtrend. And if price is coming to test the trend line on a downtrend, you have to wait. You don't just enter because price at the trend line. We can go through it and take your stop loss. So you wait. That's a trend line bounce. At times it just does a fake out. It goes through the trend line, just continues in the direction. And if it was a fake out and your stop loss was within the range, it will sweep you. That's what we call liquidity sweep. Some also call it stop hands. So whatever terminology you use is fine. Okay, that's for a downtrend. And an uptrend, when you are doing a trend line, you are connecting the higher lows for an uptrend. So you've joined the first two and extend. I'm teaching you this because that's how some people trade. Some people just trade trend lines. They draw the trend line. Once price gets the trend line again, they enter. That's all their strategy. There's nothing else to it. I know what I'm talking about. I've listened to, if you go to YouTube and look for Chart Fanatics, Chart Fanatics is a YouTuber or YouTube platform that they interview big guys. They interview the big guys who actually trade, be it crypto or forex or stocks or what the futures or whatever. If you can just go there to YouTube, you see the guy, Chart Fanatics guy. And I've listened to so many people there. When I'm bored, I go there to listen to people's interview. And there's this lady, I've forgotten her name, young lady. All she does is trend lines, and she's filthy rich. Just trend lines. Once she picks the chart and she can't see trend lines, she's not trading. So she picks the chart. If it's a downtrend, she draws a trend line and waits for price to return to the trend line and see what the price is doing at the trend line. Is it showing wicks like rejection? Is it showing a candlestick pattern? Is it showing bearish engulfing or bullish engulfing? Depending on the trend. Then he enters. And when he enters, he just targets where on a downtrend, the price will break the lower low by taking the liquidity. That's where he targets. And she's filthy rich. I'm not kidding you. She's one of the richest traders in US. And all she trades is trend line, finish. Oh, to Ghana, how to Cayman Island. Uni mother block, uni there's uniska. So the point I'm trying to make is that identify. So I'm going to expose most of the concepts to you and play with them and see the one you like and use it. You don't need to trade like me because me, I'm a bit fanciful. I like fanciful things when I'm trading. It's ego nonsense. You see, it's ego nonsense just to convince yourself that you've done a sophisticated setup. You see, but you can trade on simple things like trend lines, simple things like order blocks, supply and demand. Then look at your market structure and add liquidity concepts. I pride myself in saying that I've learned so much about liquidity that, as I was telling you guys, when I see certain charts or certain entries, I hesitate. Like when I see a demand zone, price is approaching the demand zone. However, there's no liquidity before the demand zone in front. I'm afraid because I know the liquidity will be below the demand zone. So I'll not enter that trade. Somebody may enter. Price may go up some few pips. He'll be happy. The next moment, price just dumps and he doesn't understand. Because there was no liquidity. Once no liquidity has been taken, price will not move up.
You go inside.
So let me repeat this. If you want to have access to major movement in the market, always wait for liquidity sweep. Once liquidity has been swept, price will move aggressively. The example, the gold trade that I said I would have entered, gold is struggling to move fast or go up because of the time of the day. When you are trading, there's something called time of trading. If gold did this around 1, by now it will be moving up aggressively. But around this time, market is winding up. The big players, they don't trade around this time. So they are getting out of the market. So there are very few big players who are planning to close their trades or secure their profit or something. And mostly retail traders who are moving the market. Anytime price is moving slow, it's not going anywhere. And it's around almost like not the peak time of the trading hour. Then it's mostly retail traders who are moving the market. When the big guys come, they leave their footprints. You see aggressive candles, not choppy, slow candles. So in summary again, liquidity is very important. Watch this video again. If you still don't understand, I don't mind repeating the lecture. Because for liquidity there, I will say it in subsequent lectures until we finish the course. So areas to look for liquidity, structural highs, structural lows. When I say swing lows and swing high, I mean higher time frame like 4 hour and above. When we use the word swing, it means 4 hour and above. You know what we're doing market structure? I mentioned strict structure, I mentioned internal structure, and I mentioned what fractal structures. If you remember. If you don't remember, go and watch market structure video again. So anytime you hear the word swing high, it means 4 hour and above. That's why Engineer Shaw was talking about 4 hours. Because he knows what I'm saying and he knows that he's been through that already. Then you look for liquidity at key zones. So support and resistance, demand and supply, order block, or any area you want to take your trade. Ask yourself this question: has liquidity been swept? If the answer is no, don't enter. Wait for liquidity. And as soon as the liquidity is swept, you wait for a break of structure in the direction that you intend to trade, be it a downtrend or an uptrend. Then your entry should be based on, so 3 things: liquidity sweep, break of structure, and the candlestick pattern. If it's an uptrend, are you seeing a bullish engulfing? Are you seeing multiple wick rejection from a zone? Then you enter a buy. If it's a downtrend, are you after sweep of liquidity, break of structure? What are you seeing on the candlesticks? Is there multiple wick rejection? Are you seeing a bearish engulfing? Are you seeing an evening star? Then you enter for the sale. So I bring the lecture to a close by saying I thank you for listening. Thank you for engaging me. Make time, rewatch the video. From now till our next lecture on Thursday, if there's something about liquidity that didn't make sense, please, you can write it on the platform and I'll try and explain. If I have to do a short video again, I did some short video for Reggie. Reggie Ally?
Yes, you did. You did.
Yes, Reggie asked me some questions and the way I could explain it, I had to do a short video for him alone. And I did a video for him and I sent it to him. And I think everything was clear from then. So guys, I am here. I'm your mentor. I'm one of you. I want us to grow together. So make time, watch the videos, practice, do the assignment. If you don't understand anything, please ask. Okay, thank you very much. If there are no further questions, we'll bring the class to a close. And I'll see you on the platform. Until then, bye-bye.
Bye. Good night.
Good night, guys.
Class prefect. So
Yes,
it's
sir.
tomorrow. It's tomorrow 12:30, right?
Yes.
The live trading, 12:30.
12:30.
Class prefect, make sure they all
Okay.
have their live accounts ready, not
Okay.
demo. Live accounts.
My people.
People must learn to lose money.
Yeah.
You must learn to lose money. One thing I can assure you is that as for money, you lose money.
Live account
But
ready.
you should lose small and win big.
More. Yeah.
You can even
Okay.
lose 3 trades in a row, and 1 win will bring you back.
Mm-hmm.
Yes.
Mm-hmm.
When we do risk management, it will make more sense. So for now, God willing, tomorrow we go on the charts together. You see the way I think when I go through the charts. We find a setup, applying all that we've learned so far. We enter a trade and let the trade plays out. So we are all putting a minimum of $100 into a cent account, which will come to 10,000 cents.
Mm-hmm.
Until if you have not done your 10,000 cents, you can contact class prefect to guide you how to do that. So everybody should have their 10,000. So we are all starting from 10,000 cents. So even me, do I have accounts? I'm going to create a new 10,000 cents for this class. We all enter the same trade, the same lot size, the same stop loss, same take profit. So that if I make money, you don't make money, then you're doing something wrong. So as I said, we'll enter the trade together. Same stop loss, same lot size, same take profits. Then we let the trade do whatever it has to do. If it hits stop loss, fine. If it hits TP, fine. You don't get emotional. You don't get emotional. If you bring emotions to trading, it will mess you up. So before we enter the trade, I'll ask you, are you prepared losing $10? Are you prepared losing $8? If you are prepared, let's go. If you're not prepared, you can stay out and just watch us. Yes, usura unyede, usura undi. And fear is a bad thing in trading. If you don't control your fear in trading, you can never make money. Indeed, that's right. Make sure everybody, including engineer Inshira, I know Inshira has the account ready, but just cross-check everybody has $100 in their cent account, which is 10,000 cents, ready for tomorrow. So I'm going to put this evening. Now I'm going to put $100 in a new account, ready for the class. I have my other accounts. I don't want to touch those accounts. So you will see my account. You will see that it is clean account, $100, which is 10,000 cents. We'll start together. Then we'll grow together. So that come the end of the course.
Together.
If for nothing at all, you should double it to 20,000 cents. That's you've made a profit of 100%. If for nothing at all. But I pray we make more than that. Because I'm planning that if things work well for us. Now we are only doing one trading day, which means that when I see setups on any other days, I'll share in the platform. Then you guys are supposed to take it. And I'll state the lot sizes you use. But people go and start using other wrong things and they'll blow their account. They will say the thing is not working. No, my account is not blown. So I'll state the lot size you use. Anytime I share a trade, I'll tell you enter lot size 0.25 or 0.5 or 1 or whatever. I'll write it. If you go and enter any other lot size, and before any new live trade, I'll ask for audit of your charts. I'll let you share your charts. You go to SNS, you share your chart. You go to profile, it will show you all the trades you have taken. If you've entered the wrong size, I will see. If you want to blow your account, you can go ahead and blow. But it will not be my fault. So I'm only saying all these things to prepare our mind that tomorrow we are going to trade live. So get your money ready. Class prefect, over to you. However you do, whether you call them individually or you do some WhatsApp group call or whatever, make sure everybody have the account ready for tomorrow, God willing.
Okay. My people, we here though. We need to get our accounts ready. Philip, Reggie, Inshira. Inshira, I know you don't need guidance.
Inshira is fine.
You will boss. I think Reggie too. Reggie, but get the money ready and then you can contact me by WhatsApp and let's see.
Sure.
Let's get the account fixed. Yeah, okay.
All right, guys.
Sure.
So thank you so much.
I'm late for my meeting. I've sent them a message that I'll be there at 6:45. It's also an online meeting.
Thank you very much for your time.
Yo, guys, so I beg, I'll share the video as soon as it becomes available. Watch the video again. If you don't understand anything, please ask questions. Why? In the group.
Okay.
So enjoy your weekend. Bye-bye. I say weekend,
Bye.
the rest of the day. Bye-bye.
Bye-bye.
Bye-bye.